Hello and welcome to the Sand to Pearls Stock Market Commentary. Market week ending Friday, October 11th, 2013. Market breadth. With this past week's market decline, our bull-bear point and figure ratio fell from 1.69 to 1.38, maintaining its bullish territory. The total count of securities in bullish or bearish patterns decreased 7% to 1,927. The count of bearish stocks increased 5%, while the count of stocks in bullish patterns decreased 15%. The Sand to Pearls P&F Market Breadth Summary Chart shows us a market now 6 consecutive weeks in bullish territory. Paid subscribers have access to the Excel data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking on Membership, and clicking Sign Up. For those who are interested, a free 2-week trial subscription is available. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 153 points for the 12th drop in 20 weeks. At a positive 197.06 points, it has now fallen below the November 2011 top, the lowest top above plus 100 in the last 35 months. So the NASI is now below all of the 8 tops over plus 100 and above all 6 of the bottoms below minus 100 in the last 35 months. Market Gauge Volume Analysis. In this week's volume analysis, the Russell 2000 ended in neither accumulation nor distribution mode. In the last 2 weeks, it had 0 accumulation days and 4 distribution days. Of the other indexes, both the S&P 500 Deposit Receipts and the Diamonds Trust ended in neither accumulation nor distribution mode. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Russell 2000 ended in distribution mode. Momentum. The CCI 20 dropped below 0 for 2 consecutive days, down to below minus 200, so outside the range for a valid zero-line reject signal. But it is now above 0 for the 5th week in a Woody's uptrend, and within the plus or minus 50 range for a valid zero-line reject signal. However, to achieve a zero-line reject pivot for a long signal, the CCI 20 will need to first decline again, but less sharply. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 35 weeks ago, while the daily CCI 20 began a Woody's uptrend 4 weeks ago. The CCI 20 weekly has dropped below plus 100, but remains outside the plus or minus 50 range for a valid zero-line reject entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and only 2 of the bottom 5 are negative. Bullish, gold and silver remains in and now leads the bottom 5. REITs has left the bottom 5 and entered the top 5. Disk drives and computer hardware remain in the top 5. Banks has left the bottom 5. Bearish, brokers remains in the bottom 5. Oil services remains in the top 5. S&P retail and internet have entered the bottom 5. Networkers has left the top 5. Focus this week. This week we have 2 important articles on the debt ceiling that challenge the conventional mainstream media reporting of doom and gloom if the debt ceiling is not raised. First is this article by Moody's. U.S. need not default if debt ceiling isn't raised. Quote, "We believe the government would continue to pay interest and principal on its debt, even in the event that the debt limit is not raised, leaving its creditworthiness intact. The debt limit restricts government expenditures to the amount of its incoming revenues. It does not prohibit the government from serving its debt. There is no direct connection between the debt limit, actually the exhaustion of the Treasury's extraordinary measures to raise funds, and a default." End quote. The second article is from Forbes, "The Incredibly Simple Reason Why the Debt Ceiling Just Doesn't Matter." Quote, "It would be possible for the Treasury simply not to roll over old bonds as they become due. This would give enough financial room for the system to stagger on for a few more weeks. And as that default would only be on bonds that were coming due, not on the entire market, then the repercussions of this should be manageable. Treasury could come out next week issuing, say, 30 or 50-year, there are investors who would love some 50-year T-bonds out there, bonds at, imagine, 20 or 50% coupons. The premium over face value that these would receive would mean that the debt ceiling would not be breached at all." Thank you for joining us for this week's stock market commentary. We hope that you're having a great weekend, that you have a happy Columbus Day tomorrow. Happy trading.